More than half of every Bitcoin ever mined is now worth less than what its owner paid for it, a milestone the market has only ever hit at the floor of a brutal bear market. Fresh on-chain data shows over 50% of Bitcoin's circulating supply, roughly 8 million coins, is sitting at a loss after the price slid below $61,000. Bitcoin is now down about 9% in a single week, and Ethereum has fallen even harder, dropping close to 14%. The Fear and Greed Index, which tracks the mood of the entire crypto market, has collapsed to 9 out of 100, a reading of extreme fear that almost never appears. Analysts at the research firm K33 say this level of pain is the classic signature of a bottom, the kind of capitulation that has marked the end of past crashes. But there is a catch. History shows these bottoms usually arrive only after one final violent leg lower. For now, no one can say whether this is the floor or the calm before one last drop. Europe just moved to give itself the power to switch off entire crypto platforms it has never regulated and cannot even reach. The European Commission has proposed a sweeping new sanctions measure that would ban crypto services based outside the European Union if they help Russia move money around Western sanctions. Until now, Brussels could lean on exchanges operating inside Europe, but offshore platforms sitting in friendly jurisdictions were largely out of its reach. Under the proposal, any non-EU platform caught helping Russia evade sanctions could be cut off from European users and the European financial system entirely. It is a sharp escalation in how governments treat crypto, turning sanctions rules into a weapon that reaches across borders and straight into the on-chain economy. Supporters argue it finally closes a loophole that has let billions in sanctioned funds slip through borderless networks. Critics warn it sets a dangerous precedent, because if Europe can wall off the platforms it dislikes today, the real question is who gets cut off next. While the rest of the market panics, the three most powerful banks in Japan are quietly building something together for the very first time. Mitsubishi UFJ, Sumitomo Mitsui, and Mizuho, the megabanks that sit at the center of Japan's entire financial system, plan to jointly issue a single stablecoin by next March. Instead of each launching a rival coin and fighting over users, the three giants are pooling their power behind one shared token. It would run under Japan's new stablecoin law, which gives licensed banks a clear legal path to put digital yen and dollars directly onto a blockchain. Together, these banks command hundreds of trillions of yen in assets, a level of trust and reach no crypto startup could ever match. The move signals that Japan's old financial establishment now sees stablecoins not as a threat, but as the next layer of plumbing for money itself. And it is happening while prices are crashing, a reminder that the biggest players build hardest when everyone else is afraid. Subscribe now.